Good evening. Ira Epstein with your SPDR ETF update. And this update is for a wild Thursday. And we are sitting here at the 3rd of February, 2022. Well, the kickoff, of course, Facebook. Market down dramatically, to say the least. At one point, 28% loss in value, finished down, well, but not quite that much, but quite a bit down. Amazon was no slouch either. It got hit pretty good. But after the market, some pretty good numbers out of Amazon. I saw that market taken off to the upside, so you'll see that. There's a Snap had some decent numbers, turning a corner from the looks of it. So not everything is what you think. If you were listening to the news today, you wanted to jump out a window. You thought the market and the world was coming to an end. Yet when I go in and I looked on the futures markets to see where the stock indices were for the week, you'll be surprised. They're holding on to gains in a number of them. So individual stocks all over the board, indices as a whole, questionable. A wild week, the volatility certainly not out. Part of this kicked off this morning when central banks, we thought that we'd see the Bank of England go with a quarter-point hike. We did, but what surprised the market there is out of 9 voting members, 4 wanted to go for a 50 basis point hike. Then Ms. Lagarde, who normally does very well in the question and answer period, frankly blew it today. Nobody will say that. I love her. I think the woman is one of the smartest women around. But she didn't answer the questions well, and she gave the market the impression that in the European Union, as much as they keep talking about they're not going to raise rates, maybe they will, and the euro took off over 1.25 points. That surprised markets. One of the reasons I don't go into those meetings as a futures trader trying to carry positions. You can't protect yourself. One wrong statement, markets go bananas on you. And sometimes just an innocent thing. All right, let's start off with the chart everybody wants to know about, Facebook. Now, let's get away from today and take a look at where we're at. As the market was down over here, and this is pretty important, we had a market that, as you know, had come down. Now, if we count how many days did it embed, both numbers not under 20. Under 20, under 20. Come on, one more. Come on, give me it. There you go. Not under 20. Just an oversold market. If it goes up again and clears this high, well, then I'm going to be looking, could it get to the 18-day average of closes? I would have said to you at this point, this market has now broken its downtrend. Likely target the 18-day average, and it's right where the market did stop at that point. I don't think you can fight that. This was Tuesday. Yesterday, the market, and let's get to it, this is yesterday's gain. When I put on one more day, it had to jump on the chart for some reason. I've made these all bigger for you. It probably has something to do with it, and I'll have to play with that, but I wanted it to look better on the videos. Now I'm going to look at serious resistance of the 200-day average in gray, the 100 in the upper Bollinger Band. I doubt the market's got the power to get through that with any real pizzazz. I did not see this coming, where the market goes from a decline of 26.39% in one day. There's no way I saw that coming, but it did. The earnings were a disaster yesterday, and punishment is the key word that they did to it. And it, of course, weighed on everything else in the tech sector, which affected the S&P and, of course, the NASDAQ itself. The Dow was trying its best to hold on, and then it just couldn't. Selling was coming from all sides, which is typical. Why? People sell what's good to hold on to what's bad. It's human nature. That's what they do to hold on when something's going against them. At Bank of America, the overall thing I see when I look at the chart is from low to high, we're back to about a 50% bounce in the market. The pattern on the swing line is one of higher lows. I can even take this line now and just move it over there. Unless you get under 46.30, you've got that pattern in place. If you take out 46.30, you go into a stall. You would have a higher high and a lower low on the chart. Where's the market stalling out? There's no moving average above it, so it's right here at the 18-day. That's what I expected. The market went through we talked about this yesterday, the 100, the 200, and then it got to the lower Bollinger Band. held that combination with the 200, and has come back up. It is not out of the woods. It is not a market I could turn around and tell people, oh, I'm super bullish or bearish. It's in an uptrend until you take out 4630, and at that point, it goes into what I do want to see, which is a consolidation phase, I'd hope. When we take a look at Apple, I didn't think Apple could make it up coming from here in an overbought condition the way it is and get up to the upper Bollinger Band. It would have been nice, but I don't think it's going to. Now you've got a market that has an outside day down. If on Friday or Monday today's high is taken out, I'll change my opinion, lickety-split, and look for the Bollinger Band instantly. Barring that, I wouldn't be surprised to see it go back down to the 18-day average to consolidate some of these gains. We then get over to the financial services. And we've been talking. I thought that the market, once you were coming up, would fight its battles for support first at the 100. Well, let me start it this way. For support first at the 100 and the 18-day average, that gave ground, and then the 200 and lower Bollinger Band kicked in. The importance of the Bollinger Band, when you get down to it, it's only going to stay above or below it 5% of the time. It is not a tool that you say, I'm buying it because it's going up there. Folks, it'd be like saying I'm selling it here because it's going back down there. The heat is tremendous before it has to revert, and the number it may revert when it hits that can be outside of anywhere. You don't play it that way, at least that's what I believe. So I was still looking for the bounce, and I got it. Now, as I've said on so many of the markets, I think the battleground's the 18-day average for a while, and some of the other higher averages if the markets continued over them. We'll have a couple of those examples. In Disney, not even strong enough to get to that number, so that's a bit disappointing. While you've got the trend up, the bias is down, and you have worked off an oversold condition. This market can go anywhere right here. It's not tradable as I see it. When I look at the semiconductor play, you got up and did what we thought. So you have a market that fell, and it fell very hard, as you can see in the latter part of January every day. Finally, it stuck its nose and tried to get back one time to the 200-day average. Then it crisscrossed to the right-hand side of the Bollinger Band. That's important, but the key is to get a rally, you got to lose the embedded reading. Until it's lost, you stay in the bear camp. When it's lost, you haven't lost it yet. When it's lost, you got to look at the game different and say, okay, unless it's going to re-embed the next day, and you take my course, you'll understand what that means on the enhanced Bollinger Bands. Now the odds, because you're over the 200-day, this comes into play, these two numbers, and obviously the 18 is the main number. Market goes there, gets thrown back today down here. So typical of what it does. This is that part that you've worn out the first leg off the lost embedded reading, and now the market's got to figure out what it wants to do. You resume an attempt at an upside if the market can clear 210.99, opening the door for the 221 level. If it stays just as it is, you got nothing. You've got a market that left the downtrend just the way we're talking even in Facebook, went up to a key average and failed. Same type of pattern, but it didn't have the bad news Facebook had. When we look at the home builders, can't even get up yet to the 18-day average, and there's plenty of resistance there. The market's not attracting sellers, in my opinion, because you're already in oversold territory. Anytime you have a reading under 30, I consider that oversold. Now, if the market takes out 75.13, that opens the door to start challenging some of those numbers. But right now, the bears are in control, but I don't think they're going to get help from people running over the hills to get short with them is the problem they're having. As we move on to XLE, I'm still in the bull camp. So why not? Everything's looking good. Each time you think you're going to get a breakout of OPEC plus, something happens. Now in Africa, they're losing again production. That takes oil off the market. So a lot of problems. You know, if there were a surprise agreement with Iran, you might get oil back on the market, but I don't see the Biden administration going there. I think that the criticism would be immense for him, given his popularity. I don't think it's one of the things he needs right now. So as I look at the market, it's embedded until you lose the embedded reading with the red line closing under 79. I say the breaks are being bought, profits being taken against the upper Bollinger Band and or a window envelope. In this case, it seems to be the Bollinger Band. Now we get to the gold market. Gold, in my opinion, is attempting, I know it's going to sound nuts because it's in a downtrend, attempting to give the first idea that if it can clear and get back over 169.79 on a closing basis, you'll say that's far away. It's $1.19 away. If it could do that, especially on a Friday, you could get a very interesting picture that would turn bullish out of left field. Why? You'd have higher lows, higher highs, the weekly charts would look better, and certainly the dailies, which means as you came down here, this is the support. It's the flip-flop of the stocks. You came down into the support levels. Got what I'm doing? The stocks rallied into resistance. This fell down here. Am I bullish? No. As a chartist, it's still bearish. I'm giving you the what-if scenario. I don't think it's worth anything right here until it throws out a better signal. The market that I've been bearish on is GDX. I have been telling traders, yeah, this was the sell zone. Now, I wouldn't want to see the market go back up if you sold it at that 18-day average through that. You can use a break even. That's what I think the pros will do. And I think they're still looking for 29.24 if the market can get downside target. Let's flip around. Any close over 31.04, I think you're back in the bull camp. I think you then have your higher lows, your higher high, you're over it. You have one hurdle at 31.48 and then nothing to stop the market to 32.68. In XME, this is the resistance zone. I don't see a pattern here that makes sense. All the market did is what I preach. It came back on this big rally, and it's got two levels here. It's got the 200-day, the 100, and they're basically the same price. And then you get the 18 for the resistance. Here's the market, and here's where you're at today. So I feel comfortable in my analysis of that so far. In the copper, I'll let China decide what it wants to do. Tonight's the opening games of the Olympics. Once they get going, the traders go back to their desks, and copper comes alive again. In copper, the trend is down, the bias is down, it's attacked support and found that support. Should it get up and close over 38.70, I think it flips to the upside on you in terms of a trend. I see nothing in TLT. I see a market that's waving back and forth inside sideways action in the Bollinger Bands. And in FXE, what a surprise. I learned my lesson many years ago of going through these central bank meetings where it's a shoo-in. You know what they're going to do, the market won't react. Remember I told you I'm a man of Swiss cheese. I've got the holes of having done everything wrong. I did nothing wrong on this one. I told my traders, you don't want to go into this report. It went neutral going into it last night. This morning, boom. All because I really think of a flub that took place where the door was open as to what might or might not happen. And I talked about that this morning in my Spider ETF video. That's the beauty of them. If you're a Spider ETF trader at 9 o'clock, I wait till 9 because you get so many government reports that come out between 6:30 a.m. and 9 a.m. Central Time. I want to get them in the market. I want the market to be able to absorb them. Then I want to record and talk to you. I want to show you the chart. You got a whole day of trading ahead of you. The first half hour is where the ETF, the Spider, that money's coming into the market. I rotate all these markets for you. I don't just keep them. You'll see that I'll say to you here, hey, is there a market you want me to cover? And in the morning, I'll look at the market, what's hot. I'm going to cover that in good detail. I'll certainly be all over Facebook and Amazon in the morning. We'll be talking about them. But there's where I'm saying, buy exactly here. Here's your stop order. Here's what I want you to do. Here's the objective. And I'm pretty aggressive with what I want to do because I believe in it. So if you're interested in following me, give yourself a try. It's not expensive. You're going to get 24 videos a month. Each video is about 18 minutes long. On Saturdays, I put out the weekly video for the traders that are the longer-term trader. That doesn't mean during the week I won't refer to a weekly every now and then, but the real focus on a Saturday is the weekly, and there's 40 some odd charts in there, very specific recommendations of stocks, spiders, ETFs. I move with the flow of it. Just go to our website to find out more. Go up to the word research. It's all there. If you want to learn more about my charting technique, go to education. Spend 2 minutes, away you go. And if you have any questions, my staff's there. They'll be happy to answer you. I'm Ira Epstein. You have a great day.